Good morning, Daily Hunters, and welcome back to the show. It's Friday, October 10th, 2025, and Brooke and I are here to kickstart your day with a summary of all the market chatter and AI-generated insights from yesterday.
Great to be here, Ethan. And what a day for data we had. We're seeing a significant amount of posts and interest across a wide range of stocks. It wasn't just a few names dominating, there's a lot of dispersed attention.
Yeah, the activity was really picking up, and frankly, some of the candidates showing major spikes in discussion seem to be generating a lot of excitement, particularly in the tech and AI space. It feels like there are some potentially hot candidates emerging. But as always, we've got to dig into the details.
Excitement is one word for it, Ethan. High-risk speculation is another. A lot of the volume we saw yesterday points to companies that have generated a ton of buzz. But as my KPIs often remind me, buzz doesn't always translate into a sustainable financial position. We've got a mix, I'd say, some clear long-term potential and some that are, well, let's just say very high risk.
All right, let's dive right in. First up, we've got SELSQ Corp, ticker LAS. Now this one is interesting. We saw a post yesterday with someone going all in, calling it the cheap quantum play, an AI plus security plus chips plus quantum Voltron combo stock with a government contract. They even compared its sales multiple to giants like IonQ and Rigetti, suggesting a potential 25x bagger. We've never rated LAS before, so this is a fresh look.
Ethan, Voltron combo stock and 25x bagger are certainly compelling phrases, but my KPIs are waving some serious red flags. While that projected 80% year-over-year growth for 2025 is exciting on paper, the current revenue growth is practically flat at negative 0.001. And more critically, LAES is currently unprofitable across the board. Negative net profit margin, negative EPS, negative operating margin. Add to that a very high debt-to-equity ratio of 5.393 and an unusually high negative beta, suggesting unpredictable volatility. This isn't a cheap play when you factor in the financial health.
You always bring us back to earth, Brooke. But you know, sometimes you have to look at the future potential, especially with those strategic partnerships and government contracts. It seems like the market sees a turnaround coming.
The market hopes for a turnaround, and that's the difference. Based on the fundamental KPIs, unprofitability, high debt, and current flat revenue despite future projections, this is too speculative for a fundamental investor right now. Our classification for LAES is stay away.
All right.
Brooke, the enthusiasm is palpable, and I acknowledge the recent news about an adjusted profit and revenue beats in Q1. However, the fundamental KPIs still tell a very different and frankly concerning story. The overall trailing 12-month revenue growth is still negative at negative 0.023. More importantly, TLRY is still deeply unprofitable on a GAAP basis, with a net profit margin of negative 2.6625 and an EPS of negative 2.42. And its debt-to-equity ratio is exceptionally high at 22.069, which directly contradicts the post's claim of having more cash than debt.
But the market is so focused on the potential legalization. The next 1 to 3 years is going to be huge for cannabis. The stock is near its 52-week high.
That short-term momentum and speculative hope are driving it for sure. And that high beta of 2.129 proves its volatility. But for any long-term, fundamentally minded investor, the persistent gap on profitability, negative revenue growth trend, and that alarming debt level are simply too risky. Despite the short-term excitement and the partial positive Q1 news, TLRY remains a stay away. We've seen this pattern before.
Okay, let's talk about Rigetti Computing, ticker RGT. This company was mentioned in a post as an example of an overvalued peer in the quantum computing space, with someone saying RGT 1500x in valuation. We've actually had RGT as a stay away 3 times and a speculative gamble once in the past week.
That user's assessment of RGT being overvalued is spot on, Ethan. My KPIs show a company with negative revenue growth of negative 0.416, completely unprofitable with an EPS of negative 0.88, and an astronomical price-to-book ratio of 27.565. Despite these abysmal fundamentals, it's trading near its 52-week high. There's even a 2x short ETF launched for it. This is a classic example of market hype vastly outpacing any underlying business performance.
So the AI frenzy might be lifting all boats, but not all boats have solid hulls, right?
Exactly. Its valuation is entirely speculative, driven by buzz in the quantum space, not by any tangible financial health. RGT is another clear stay away.
Okay, next, Nebius Group, ticker NBIS, was quite a hot topic yesterday with several posts. Users were talking about full porting my Roth, individual, and HSA into $NBIS calls, too good to fail, and even projecting it could be a $100 billion company. They highlighted huge strategic partnerships with TD SYNNEX and Microsoft. NBIS has appeared on our stay away list 4 times and as a speculative gamble once in recent weeks.
Ethan, the community enthusiasm for NBIS is incredibly high, especially with all the AI buzz. It is trading near its 52-week high of 135.76, up massively from its 1409 low. However, its valuation is frankly exorbitant. We're looking at a PE of 172.26 and a PB of 8.39, while its profitability is razor-thin to negative. A net profit margin of just 0.98% and a negative operating margin of negative 106% means they're losing money on their core business activities. Plus, the debt-to-equity ratio is a staggering 32.43. The 7.7% revenue growth is positive, but it's modest compared to the valuation.
So all that AI buying spree and cloud expansion news isn't translating to the bottom line yet?
Not nearly enough to justify its current price. The disconnect between speculative fervor and financial reality is stark. A negative operating margin, high debt, and modest revenue growth simply cannot support such a sky-high valuation. NBIS remains a stay away.
Okay, let's look at IonQ, ticker IONQ. This one also came up in the LAS discussion as a benchmark, with IonQ being referenced as a highly valued quantum computing success story at a 250x sales multiple. We had IonQ as a stay away just a few days ago.
And for good reason, Ethan. While it's trading near its 52-week high of 82.97 and shows impressive revenue growth of 0.818 or 81.8%, it is still deeply unprofitable, an EPS of negative 2.06 and a negative operating margin. The price-to-book ratio is very high at 17.985, indicating a valuation heavily dependent on future potential, not current assets. The news also mentioned bubble concerns and articles questioning where are the bears.
But for a disruptive technology like quantum computing, sometimes you have to burn cash to establish leadership, right? And being on the Fortune Future 50 list sounds promising.
True, early-stage tech can be capital-intensive, but the level of unprofitability combined with such a premium valuation puts it squarely in the high-risk category. For most investors, IonQ remains a stay away.
Okay, here's a big one. NVIDIA, ticker NVDA. The post yesterday was incredibly bullish, highlighting its dominant position in the AI chip market, $5 billion investment in Intel, and a landmark strategic partnership with OpenAI for massive data center deployments. We've been a bit cautious on NVDA, shifting between stay away and cautious buy recently, with the last 3 ratings being cautious buy.
And for good reason, Ethan. The valuation has always been a concern. However, today's data and the AI-generated insights are pretty compelling. The stock is near its 52-week high of 195.3, currently at 192.57, reflecting strong momentum. Crucially, NVIDIA's revenue growth is a staggering 0.556 or 55.6%, And its net profit margin is an exceptional 0.5241 or 52.41%. That's converting massive top-line growth into incredible profits. While the PE is high at 55.02, it's supported by genuinely robust earnings and growth. The news confirms analysts are raising price targets and reaffirming buy ratings.
This sounds like a clear upgrade in conviction then, right?
It certainly does. When you have market dominance, strategic partnerships ensuring massive future demand, and the KPIs reflecting both explosive revenue growth and exceptional profitability, the picture changes. We're seeing strong fundamentals here, not just hype. NVIDIA is upgraded to a buy today.
Okay, let's talk about Applied Digital Corporation, ticker APLD. We saw a few posts, all super bullish, with phrases like APLD to the moon, rocket rocket, moon moon, and users reporting they doubled my portfolio and are predicting a 10x in the next 1 to 2 years thanks to the CoreWeave contract. We've rated APLD as stay away twice and speculative gamble once in the past.
Ethan, the excitement is undeniable, and the stock has seen a massive run, from a 52-week low of 331 to its current 29.29, near its 52-week high. That does validate the user's personal gains. However, this is still a fundamentally risky play. Applied Digital remains unprofitable, with a negative net profit margin of negative 1.60 and an EPS of negative 0.88. In fact, despite a recent Q1 revenue surge, their non-GAAP loss widened. Add to that an extremely high beta of 6.592, meaning extreme volatility, and a high debt-to-equity ratio of 110.92. The price-to-book ratio is also very high at 13.235.
So despite the strong revenue growth driven by AI data center demand, it's still a struggle for profitability?
Precisely. The valuation is pricing in huge future growth, but without current profitability, and with extreme volatility and high debt, it's a very precarious position. APLD remains a stay away.
And now, PayPal, ticker PYPL. This one generated a lot of buzz yesterday, centered on agentic AI and insane option flow. Users were jumping in, even with initial losses, saying, "In for the ride, let's go." This is our first time rating PYPL on the show.
The enthusiasm for AI integration is certainly contagious, Ethan. And the short-term option plays mentioned in the post actually did turn out profitable for those dates, which adds to the narrative. But looking deeper, while the PE of 16.22 is relatively low and could signal value if AI delivers, the revenue growth is moderate at 5.1%. More concerning is the high debt-to-equity ratio of 60.254. The AI story is still largely speculative. We don't have concrete evidence of how it will fundamentally transform PayPal's profitability or competitive edge in a sustainable way.
So even with the AI narrative, it's not a clear buy for you.
Not yet. The market is pricing in potential, but the underlying metrics need more to convince me of a low-risk entry. For highly speculative options or for those hoping for a quick AI pop, the risk is still considerable. Our classification for PYPL is stay away.
Finally, let's talk about UiPath, ticker PATH. Wow, the posts for this one were just exploding yesterday. We saw multiple users celebrating insane gains, $45,000 profit in 24 hours, on the right path, with talks of AI boost and ambitious price targets like $25 to $30. They were highlighting AI integration and partnerships with NVIDIA and OpenAI. We've rated PATH as a stay away an astounding 5 times already.
And Ethan, I hate to be a broken record, but unfortunately, the KPIs haven't changed the tune. The stock is trading near its 52-week high, currently at 1851, up significantly from its 938 low, so those short-term gains are real. However, the fundamental picture is still very concerning. The price-to-earnings ratio is an astronomical 617, indicating extreme overvaluation. Its earnings per share is a minuscule 0.03, and critically, its operating margin is negative at negative 0.05. That means they're losing money on their core operations. Plus, the debt-to-equity ratio is high at 4.761.
But the community says it's an AI player, that it's just getting started, and some users with industry experience were even talking about its pivot from traditional RPA.
While the AI narrative is strong and news mentions an AI boost, the underlying financials simply do not support this valuation. A negative operating margin, razor-thin profitability, and that extreme PE mean it's entirely speculative. There were even comments from what sounded like industry insiders calling their tech pure ass and bloated. The current price is driven by hype and momentum, not sustainable earnings. Path remains a stay away.
Finally, let's round up today's candidates for deeper analysis. Based on our AI-generated insights and market commentary, here are the stocks that we think deserve your closer look today. Investigate as buy: Apple Inc., AAPL, NVIDIA Corporation, NVDA, Palantir Technologies Inc., PLTR. Investigate as cautious buy. No candidates for cautious buy today. All buys showed strong conviction. Investigate as speculative gamble.
Now for our speculative gamble of the day, Ethan, and I looked at all the stocks we classified as stay away and picked the one where the community sentiment was most overwhelmingly optimistic despite the underlying risks. For today, that's definitely UiPath Inc. Path. The sheer volume of users celebrating massive gains, betting big on an AI boost, and setting ambitious price targets really shows a fervent belief in this one. It's a high-stakes play, folks, so approach with extreme caution. UiPath Inc. Path.
And that wraps up another episode of The Daily Hunt.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions.
We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in, everyone. We'll be back bright and early tomorrow with more insights to kickstart your trading day.
Happy hunting!